and welcome to BQ Conversations. My guest today is the group's Chief Financial Officer of Tata Motors PB Balaji. Balaji, thank you for joining us on BloombergQuint.
Thanks for having me.
Let me begin with this is 6 months in Tata Motors for you. From handling unit economics of soaps and detergents to unit economics of cars and trucks, how has it been a change?
I think it's been fascinating fun because in some matters they are similar, some matters they are very different, and it's quite a interesting experience to figure out which parts are similar and which parts are different, and accordingly tweak your approach. So it's been an absolutely fascinating 6 months. I wanted an excitement and a challenge, and both are there.
Okay, I'm starting off with the investment plans which you have. You elaborated at the press conference yesterday. Nearly $5.6 billion for JLR and nearly $500 million for Tata Motors. That's over $6 billion plan that you have for a year and a half going to 2020. How are you going to fund it?
I think the starting point of funding any investment plan is the operating cash flows of the business. And we are very clear that that is the number one priority for the business. And it can come from various ways because you need to generate growth. That's always the best source of money. And then, of course, it starts playing out slightly differently by businesses. There's one thing which JLR needs to be getting their act even better is on the operating leverage side, which I specifically called out. And as far as the CV business here is concerned, keep growing, gaining share, and continuing to drive the cost reduction that you have. That's a brief for the CV business. And as far as the PV business is concerned, it's like get your capex right, get your contribution margins right, and ensure that you're having a strong pipeline of products coming through so that you can continue to win share. So we have differentiated each of these approaches customized for each of the businesses because the challenges are different. Because if I tease out the challenges, I think as far as the JLR business is concerned, I think for them UK is going to be a challenge, and therefore having accepted the challenge, how are we going to then prepare ourselves for that, which could be which is a combination of things that we would be doing. One is, of course, getting the electrification roadmap.
True, I will come to each of those cylinders which you spoke about one by one. But before that, your net debt for the automotive division was around 13,000 or 14,000 crores.
Yes.
That came up from 7,400 crores, if I'm not wrong.
That's right.
Now, $6 billion which you're doing, clearly that's not going to come through cash flows. It has to be a debt raising or equity infusion, or this has to happen. What are those plans you have?
I think there's absolutely no equity needed as far as at this point in time. It's a very strong balance sheet that we have at an overall level. Net debt, EBITDA, all numbers are very, very comfortable there.
So that would go up?
No, the first starting point. Why? When I look at you can put the full capex number together. I would rather look at what is my net FCF that I'm going to land up in after all the free cash flows. We do not expect that to be significantly negative. There will be a marginal negative is what you would expect in the near term, but that's something which is easily managed by stepping up the debt level that we have, for which we all have the RCF is in place, mainly it is JLR rather than Tata Motors, because Tata Motors is cash flow positive at this point in time. So the big one is JLR, for which they have almost 2.9 billion of revolvers that are available to start with, which means there have not been undrawn facilities. And then, of course, they will issue bonds, which is their normal course they're doing. Their liquidity is absolutely adequate. And if you look at the liquidity stretch, which also we have shared, they are well spread out over the next 10 years. So I'm absolutely relaxed about that.
And so it's foregone conclusion that the debt levels will go up from here on for Tata Motors consolidated.
That is the reason on the other side we have talked about in divesting the non-core, because we would want to be absolutely clear that am I comfortable with my net debt for auto levels? Absolutely not. And we would want to bring that down. That's the reason we called that out as a specific cylinder. And one of the reasons we have called out divestments of non-core is to get that net debt down. I think, will it be fully meeting my expectations, implementing all that? My answer is that let's wait and see how it plays out.
Now let's go to the 6 cylinders which you're talking about, starting with JLR.
Thanks for first receiving the 6 cylinders.
You have gone into the auto mode, so let me start with JLR first. You have laid out a long-term EBIT margin of 7 to 9%. What will it take to reach that? Because it's almost doubling your EBIT margin from current levels.
I think, great question. I think multiple factors. We are now, when we gave that 8 to 10% original, which Ralph talked about, once you adjust for PDC costs, at the same 7 to 9%. We have not done anything at all on that side, which means from a cash perspective, nothing changes. What you've done is you created the stepping stone of how we intend to reach there, so that we now put out between FY19 to FY21, we want to do a 4 to 7% range. So that's my first focus point as to how to deliver that, and we'll talk elaborately about that in the investor day. But to tease out the areas which I already covered in the investor deck, first is growth. Because a business of this size, a 25 billion pound business, if it grows, it generates, it's a brief is simple: grow, keep your cost structures tight, you will then deliver operating leverage, automatically you're on. JLR does not have a contribution margin issue. They have very strong contribution margins, which means growth will deliver the delta profit. You keep cost structures right, you got there. But in a situation, the reason why they got into a bit of a jam is when you plan for significant growth well ahead of what you're there, you will obviously trip up in case growth doesn't come up. That doesn't mean they've fallen, it's a trip. And once they correct their cost structures, the money comes spewing out. And the visualization I'd like to give you is that it was a business that was running on an autobahn at 180 miles per hour. There's now a turn in the road. When you're turning in the road, you just slow down a bit, get your cost structures right, and then you turn and then start accelerating again. The fact, when you're just going to measure it basis, you're turning vis-a-vis a 180 billion, actually you should be delighted that there's some very hard calls that have been taken, which it is strewn across the entire presentation that we have made yesterday. We have now we have changed the capitalization policy. We have impaired projects that we don't intend to continue because they're not affordable, not because we don't like them.
So you're putting a return on each project and then taking a call, right?
We are now, let me explain what you have done. We have said that this is the capex envelope we would want you to operate under. Earlier, you get a business case going, you spend the money, you get the business case, you're going. What happens if volumes don't come through? That's what has happened to us here. So we said, hold, that's not the way we'd love to operate. That's the starting point. We now introduced an affordability gateway in the financials, which is the reason the accounting policy we've changed, saying that you may have great business cases, but the total money available we want to fix you is this. Now you start prioritizing across business cases, and that is the basis on which you have taken impairments both in JLR and Tata Motors. You will also notice that we are now moving in unison. There is only one policy change. It is in both places, and prioritization happening both places.
Why did it take 10 years to come to this kind of unison policy?
The policy was always uniform, in both cases. Keep in mind they were earlier in US GAAP. And when the original JLR started off with US GAAP and went to IFRS, yes, and the policy at that point in time was Tata Motors policy and JLR were together. We are now saying that the affordability metrics we are now introducing simultaneously in both places. So therefore the rigor, as a team we are clear that the demand environment has changed. In that situation, value creation drivers can also change. That doesn't mean you drop all the value creation drivers. It basically means that be prudent in capital, be prudent in demand, be prudent in cost, just be careful on every step of it. And once you have done that, money will come spewing out. You've seen that happen in Tata Motors. Nobody expected us to deliver a 700 bips operating leverage. We grew at this level, but the cost line just kept held steady. When you do that, automatically margins come up. And therefore, this business already has healthy contribution margins. You hold operating costs, imagine what it does to your operating leverage. So therefore, that's the way we would love to
So is it
operate.
fair to assume that, in the last year, we saw 3 to 4 new launches for JLR? And 5 launches. And, most of them were 3 to 7 months period. So the full year is going to happen in FY19. Between now and 2020, when you go all electrified, there won't be many launches which will be coming in. It's more of a product development and investment phase for JLR.
I think the phase of these 5 cars first need to be juiced. So this year is going to be an exciting year of full year impact of all this. Then we get IPS going in now. Then we have the electrification roadmap coming on the entire portfolio. And the future products we'll talk about at various points in time. So therefore, the innovation pipeline is not going to stop. Because just because you got a cost challenge doesn't mean you stop innovation. It doesn't work that way. You have to have this and that. So it's an and business that you're talking about. But at the same time, there is a very clear call out saying that take a hard look at your fixed cost structures and stress test them. What happens in a situation? Look for productivities. Look for all aspects of your cost structure envelope as much as you look at your contribution margins. Look at your, just because we have healthy contribution margin doesn't mean there's no place to go and look. Why are we going for the MLA architecture in JLR? The reason you want to do that is that your cost starts getting optimized across. So on the same platform, you can create multiple cars. Same thing happening in Tata Motors as well. I think the word, it is one word I want you to remember in both these things is that discipline, 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 strategic, very clear calls. I think iPace is where it's the right time to bring in iPace at this point in time. I think one is the excitement of the product, but I'm even more excited about the way they've gone about doing it. People ask us, why are you not sharing with others? Why are you doing everything on your own? But iPace got manufactured in a third-party setup. Now the most, what I would call is the easiest thing to actually share is capex on factories.
Yeah.
We have done that there. Then of course is how you're gone about building. We haven't invested in cell technology. We don't intend to build cell technology, but we'll package our batteries together. Why do you want to pack the batteries together? Because that gives me the structure of the vehicle. Therefore, you would want to own it. We are now winding our own motors because that we are able to give performance better, far better than the market leader at this point in time at a global level. The reason why iPace is so exciting is that it is a world beater, the first premium SUV BEV done internally for all the clever areas and fully outsourced for areas that we don't want to have this one on. We didn't stop with that. That ticked the box vis-a-vis electric. And it's already available on order, and thereafter it'll take off. The more interesting is what we did with that, because we took that, fitted the autonomous on top of it, partnered with Waymo, who is the world leader in autonomous, and did that. Now, in doing so, we have to crack multiple things with one stone, because now we have figured out the background IP is with Waymo, foreground IP as to how to integrate it with our vehicles, we know, which means we are learning like mad on autonomous without actually busting the bank on that with the world leader. And it gets even more interesting. You took that and sold 20,000 vehicles to Waymo, which means your cost of building this whole lot is getting amortized on the 20,000 vehicles itself, and then you get a 1 billion turnover at the end of it, all within 2 years. Now, there is no better way of being clever about choosing where it is than what we see out here. So that is how we would want to play this game. I think JLR is doing a fabulous job of navigating this part of it very cleverly. For them, while we are looking at them very coldly as what's your growth and what's your EBIT, I think there are so many things happening internally which are so exciting. You just need to get your cost structure right. Suddenly this will just be it'll be viewed very, very differently.
So let me come to the geopolitical stress which is there in JLR. You have Britain, then you have Europe, where you said now things are looking a little better, and then you have now the duty structures which have certainly come in from China. All three. In all these things, at least 50 to 60% of your sales are coming from these three regions.
That's right.
How are you going to manage that kind of thing? Because Britain is still uncertain till the end of the year. Europe, a little bit of certainty has come in, but again, it's going to be a slow start. And China, we don't know how competition is going to react.
I think let's start with UK. I think as far as UK is concerned, Brexit is I think the diesel part of it, once we get our portfolio methodically, because look at by 2029, majority of the portfolio goes electric. By 2020, everything has got one electric option. That is the way to play that risk so the consumer is neutral to that. And we have seen whenever you put an electric product in the market option, the plug-in hybrid option, sales are back to where they were before. So there's no brand issue. It's a consumer worry issue about residual values. Once we get that right, product is starting to sell, no worries there. Brexit is a key conversation to be had. And what is the contours of the Brexit? Nobody knows. So therefore, that is something which we are very closely working with the government there, very closely working with a lot of industry bodies to ensure that it is represented correctly and we get the right decision for everybody involved in this. That for me is if I distill out everything else in this one thing which we are beyond the point we can't do much about is contours of Brexit. Yeah, that's clear. Europe, as far as concerned, starting to come back gradually. Anyway, the Slovakia plant begins by end of the year.
Yeah.
And
what will be the capacity for that?
We're at about 100,000 vehicles, so we're comfortable on supplying. We start with a few models and then the rest goes in as well. So some element of Brexit will have an impact on what are the contours of the export-import transactions that happen. But Europe gradually coming back is a call-out that we wanted to make. China, I think the customs duty reduction in the long term is going to be beneficial for JLR. We welcome that development. We explicitly said so yesterday. And as far as that conversation of how to build the Chinese business going forward will have to be thought through, and the teams are all over it.
So that brings me to the second cylinder, which is Cherry JLR, which is there. What is the kind of investments you're looking at China at this moment? Because 45% is localized, I think, and 55% is imported. That's what you told me yesterday.
That's right.
So what is the kind of investment there? Are you bringing more capacity?
At this point in time, they have about 5 odd nameplates, if my memory is right, that they make there, and that's what we intend to keep at this point in time.
And no volume growth?
They're on a strong growth path. They should continue continue to grow. There's no worries as far as China is concerned.
And so you're not additional investments not going to come in from into China?
Not at
market.
this point in time. It's a profitable, cash accretive business, so there's no worry at this point in time.
Okay. Another thing which we wanted to look at the PV business, which is the third cylinder for you. Now, you ended fourth quarter with 6.5% market share, whole year 5.7 market share.
6.8.
6.8, 5.7 for whole year and 6.5 for the quarter. To start with, it's for last 2 years we've been gaining market share gradually there, but it's a very competitive market there.
True.
And you have taken some hard calls in this market going forward as well. Will it help you to cross the 10% market share barrier, because you have a target of being the top 3?
That's right.
In the domestic market?
That's right. We have said that very clearly. That's a vision that we have put out there, because that's what gives you a credible play. A podium finish is important, otherwise we are no point playing in this game. So therefore we are clear that it will be there. We want to get there. And we are also confident that with the green shoots coming up, with the kind of consumer response we are getting on our products, with the kind of consumers we are getting on the product, the kind of some very simple statistics, 85% of my products are bought by individuals, which is a very important piece. We are selling a lot of it to the fleets earlier. That has changed dramatically. That number will go down further in the coming year as well, because as we phase out the Indicos and
Indicas.
Indicas.
Because a lot of auto companies are now tying up with shared economy to increase as we move to a shared economy, and you're moving back to the individual customers.
This is more than the customer segment here. I'm more excited about the way the brand is perceived. Yeah, first there is a brand that has to come together, then we can figure out where to take the brand to. I'm not for a minute saying that fleet brands are not appropriate. My brand has to first stand for something where people love my brand for what it is. It can't be you just forget the brand saying there's a white car that's landed up in front of you. You can't be like, you have to first love the brand. And that's the starting point. And coming from an FMCG background, brand is everything. We start from there. And therefore I'm so happy to see that brand is starting to land, that the consumer is now buying it. And most of these are young consumers, which means between you and me, most of us will not understand their psyche. They're very, very different guys, and they're very individualistic. They're highly, they're edgy. They have a point of view on everything. They're rebellious.
Tech savvy.
They're rebellious, which means they have a counterpoint on everything that you say. And if my majority of those kind of consumers, that's very exciting, because that fits in squarely with my design philosophy, which is where it is making people turn around and look at the next one saying, what was that? Where did that come from? And those edgy guys, so impact to design is core of how this brand is now starting to grow out. That's the third point. Then you come and say that you look at your JD Power customer service index, because that's where we are faltering big time. We are now number 2 with the market leader, which is very reassuring. And we should take it forward even further. So I think most importantly, my contribution margins are sequentially increasing as mix is improving. All this tells me, boss, we have a healthy business, or rather the outlines of a healthy business that we can build with this. Otherwise we would have had a very different take on this. If none of these had happened, we would have had a very different take. And one thing you can tell us that we have been very, very carefully assessing every part of the portfolio and chasing what to do, what not to do.
Is it fair to say that now you're trying to get a brand recall for customers between say 25 and 35? That's a big customer where they have the pricing power, and they are the profile which you mentioned, and so the effort is to catch them.
That is my clear target segment. You'll find our products are all speaking to them, every one of them methodically, and even the future ones, the Harriers that are getting launched, will all be speaking to them. They are different. The Tata cars will be different. They are not run-of-the-mill cars, and therefore we now want to get that business, having seen the green shoots, get it to a sense of winning sustainably, which is profitable break-even ASAP. So that's a clear call out of turnaround 2.2.
And it's not about how to get into the entry level 1 lakh car or 2 lakh car. And it's not about that. It's about brand and value for money.
It is about where is the consumer going today, or where is the consumer going to go tomorrow from here. What appeals to him, and how are we going to fit it in? How are we going to make money with that? These 3 have to be answered together, and we are absolutely clear. You get this right, we will be a strong number 3 player, and we will make money on this.
So you recently took the decision to take off Indigo and Indica. What about the nano car? And will you be bringing in cars to those segments where these products have now lost their shelf life actually?
So as far as any product has its life cycle, it runs through its life cycle. We believe at this point in time, Indica is, if you look at my growth of 34% that we have delivered, it is after a 54,000 unit drop in cars, which means we are picking up volumes big time in the other ones to even overcompensate for these losses there. And that is just the nature of the life cycle. I think we shouldn't read too much into it, other than it's just normal business as usual decisions. As far as the nano is concerned, I think come 2019, in its current form, it will not meet crash norms. So if anyway, you have to rethink how we are going to approach that. So very much huge amount of thinking will happen in the organization, is happening in the organization. And once we are ready with the decision, we'll tell you.
And what about, you came out with certain fit for future charges in the quarter. As far as Tata Motors is concerned, you took some charges with respect to Resmo as well. This is something which was unveiled a few months back. Now, you unveil a car and then take a charge because it's not the car for the future. That's what you say.
It didn't say car for the future. We can't afford what it requires to build the brand. So that doesn't mean that we are not open to finding a partner and then from which we can actually explore this opportunity if it is available. I think, which is what I'm saying, you will find us being very clear about.
That's a bold move actually.
That's how I'd love you to see it. It's not that we have been erratic about it. We have said, boss, winning sustainability is a brief for PV. If you have to win sustainability, be careful where you're investing. What are the long-term players? And like I said, this is the total capex available. What is your thing that is going to make sense? Okay, fine. These things make sense. Resmo is not falling into that setup. Is it going to make money in this horizon that we are looking for? Because I have to reach break-even as a priority. In that, Resmo is not fitting the bill at this point in time. So we said, okay, park it. We have ensured it is ring-fenced and ensure that it is in a position to actually be monetized if need be. Park it there. But until you find somebody, you have to anyway write it off because you're not finding any commercial streams onto it. So accounting prudence has been exercised, but the technological capability exists. If we can juice it, we'll be delighted. If not, one fine day we'll make money and figure out a way to juice it.
3,500 crores is what you earmarked for Tata Motors India. I assume
that's what you spent last year.
And for the coming year?
More on a long-term basis, where there's a BS6 investment that is out there for the next 2 years which we need to factor for. But on a sustainable...
How much would that investment
Wouldn't want to get into the specific numbers there, but on a sustainable basis, Tata Motors won't require more than about 4,000 odd crores.
And that would come purely from the free cash flow?
Absolutely.
Which will come in.
Absolutely.
And purely for BS6 models, right? In that sense?
No, I'm saying on a long-term basis, 4,000 crores is what capex you should
over the next 2 years, or how many years?
4, no, on a long-term basis, if you want to
run a Tata Motors, actually?
No, just keep the BS6 out of the equation. Okay. If you have to run a business like Tata Motors, its scale, its size, it will require about 4,000 crores of capex every year. Okay. Therefore, my operating cash flows needs to be at least 4,000 crores to begin with.
Yeah.
And then comes all my own aspirations of taking debt down and all that. So that's how I would want you to look at the financial model that we are mentally thinking about.
Will that mean that you will also be looking at coming out with new innovative models ahead of the 2020 BS6 guidelines?
I think BS6, park that aside, models, consumers, for a consumer, BS6 doesn't make any difference.
The industry now talks about, we're going to be slow with new launches because we all are preparing for BS6.
No. We have nothing. We have no such thing. We need to be clever enough to ensure that we are mingling the two together. My Harrier is getting launched in 19. Look at the portfolio which Girish has filled up on his commercial vehicles. None of it is stopping waiting for BS6. Because keep in mind, for a consumer, BS6 doesn't mean anything. So it is just something changing from, a chemical factory added to the end of the car. That's what he looks at it. Therefore, he wants have his breakfast, lunch, dinner full time. So we need to be prepared for that.
Okay. Next one is the commercial vehicles, and that's a very tricky one because you've been heavy discounting in the market.
Sorry?
That's what your industry competitors say, that Tata Motors...
they can be saying that. You shouldn't be saying that because you are making it a statement. I challenge that.
Yeah, and... and in the last 1 year, you have arrested the fall in market share, but even being aggressively selling it, the market share has gone up by just 50 bips for you. What are you doing to ensure that you have an aggressive growth rate and as well as increase in market share?
I think winning decisively the brief for CV. Yeah. Let me set the record straight as far as discounting is concerned from our point of view. I don't want to talk competition. As far as I am concerned, my variable market expenses for this year is significantly lower than last year. with that, the discounting question is over, because if I'm not spending, I don't know where else I'll get money to do it if my VME is lower. That's where I account it. That is lower than last year, full stop. As far as overall model of CV is concerned, one of the things you should remember is that the environment has changed from overloading to rated payloads.
Exactly.
Which gives me enormous opportunities to cost engineer out. And that game has just begun. So therefore, we'll continue to do the cost engineering to ensure that we are delivering the right one. Now here I'm not talking VME. I'm talking contribution one, the DMC cost that we have in creating a vehicle. That is how we are going to improve our profitability both on DMC and VME, both together. And more importantly, as far as the overall customer is concerned, it has to be solutions. It just can't be a pricing that you dare, which is the reason we introduced a 6-year warranty, for example. Yeah, there. As far as the share is concerned, I think if I look at it's the first year after 7th year that you've done it, the share increase. My volumes that I'm selling in the market, I still don't supply the full demand that is coming to me, simply because my supply chain is not yet ready for full services that we could render. And
how much time will it take for you to?
I think we have ramped up from about 16,000 vehicles that we used to sell in the month of April. We went up to 49,000 vehicles when we finished out in March. So that's a kind of ramp up we have put in place there. Still not sufficient. So rest assured, if there's one place there is monstrous heat in the company, it's to ensure that we get everything else right. Our vendors need to ramp up, and you'll find that is a conversation wherever you go about Tata Motors getting its supply chain ready and picking it up. And we would want to ensure that we are working with reliable vendors. Therefore, reducing the vendor base is an important piece for that, so that people have the scale to ability to invest, so that we can grow, because the growth is definitely to be taken. So therefore, there is a lot of work happening. When we're expecting in the next 3 to 6 months, this supply chain issues will all be fully ironed out, and whatever I get as an unconstrained demand in my SNOP, I'm able to produce on a weekly basis exactly in line with that. That gap is still too high for me to just say we have got our supply chain right.
And do you see any headwinds coming in this segment?
I think for me, if there are two things that worry me as far as this segment is concerned, is two. Number one, inflation. Inflation coming from various routes, rupee depreciating because of trade account, yes, or crude prices going up, hence diesel going up, and therefore inflation in the overall economy, or freight rates not rising to match inflation because the consumers, the drivers and the fleet operators are in trouble. That for me is one concern I have.
Fleet, and I was speaking to Girish as well, and Girish was telling me that, of late fleet operators have started coming and saying, fuel prices are going up, and that's worrying them, and so they're taking a hard look on whether to expand the fleet or not. Is that going to be a big worry for your segment? Because CV has been performing well, but this could be a dampener going forward. Right?
No, therefore, I've called it out specifically in my this one. There's two things that worry me. Is this one is number one, and number two is interest rates. Because if this continues this way, then you'll have interest rates will have to rise in order to quell that. But I'm absolutely confident between the RBI and the government, they will be taking all steps to ensure that inflation is kept under control and interest rates are also managed well. But of course, this can't be taken lightly, and this is something which I'm sure everybody who worth the salt is really going to look into it extremely carefully. And for a CV business, these two become very, very important, and it is important that we don't lose this lovely bounce that is coming back in this, because the cycle has just started. Typically it goes through 3-4 years, it goes. This is the first time it has started there, so we shouldn't abruptly end it because of these reasons. But when you looked at the kind of investments in infrastructure, overloading restriction, GDP growth, on balance I am more optimistic than worried, which is the reason we said we are optimistic about demand. But we shouldn't we should move fast as far as inflation and interest rates are concerned. Worries of those need to be quelled.
Turnaround 2.0 for Tata Motors domestic business, yesterday Gunter was also talking about that we are still work in progress. What exactly is the timeline for this turnaround which you envisage?
I think for me, first timeline for turnaround.
Let me ask you this way. What are the milestones which you're looking at for those timelines?
Let me start with a very basic one. First milestone, declare dividend.
How far are we from that?
So I made profit this quarter. Had it not been for the one-off charges. Now these are the kind of calls that you're making. It would have been very easy for me to postpone the capitalization decision and say that we have declared profit, put a dividend, and we have turned around. We have said no, we won't do that, because then we will compromise tomorrow. We want to be a sustainably consistent, competitive, cash accretive business. We are very clear about it, so we will take those tough calls. So we have done that. Now that you have done that, the profitability is on. Look at last quarter's profitability of Tata Motors standalone. Look at last quarter's profitability of the last year's profitability of Tata Motors standalone. It is making money. It has generated cash. So therefore, we said, okay, hold, take this tough call, correct for it future, then tomorrow will be even stronger. Why did we change the dividend policy of JLR? Because we believe that's the right thing for that business, because people are confused about a 150 million pounds sitting out there. It doesn't connect to anything. So I said, clean that thing out, make it as a 20% of PAT for this year, because that works out almost 225 million. And then you say, make it to 25% next year. Why 25%? Look at the auto majors who are in the world. They're anywhere between 25 to 40% kind of dividend ratio there. So I said, let's first get to the base camp, which is get to the 25%. And that was fine. So we are taking those calls methodically and ensuring that we do it the right way, because we don't want to kill the goose that lays the golden egg. We don't want to do that. So once you have done this correctly, the milestone number one is declare a dividend. Make profits, declare dividend. But that's not good enough. Then about, okay, what are you going to ensure you get to this EBIT margin spaces that we have given with two of these? That's not good enough. How are you going to win back share? So this journey of turnaround, you'll get bored of us talking about it, because that's the reason we want to embed deep into this culture. Because one thing Tata Motors really need as a group needs to really get into is discipline, focus, and ruthless execution.
So we expect few years for the entire turnaround to happen, right? Dividend may happen next year, but your EBIT, your market share.
Turn around to the mindset, not just the way a word. It's how we want to operate. Why are we saying the three things about this turnaround you said is going to be clear for Tata Motors domestic? Win decisively in CV, win sustainably in PV, and embed this turnaround culture deep in the organization. These are the three things we'll keep hammering in, because it takes time. You don't keep changing strategies every day. And once people get the drift, why do we put an ESOP in this whole lot? Yeah?
Yes, you did.
But that's an important step in this journey. Because we said, and this ESOP will cover off almost up to the next 5 years. Because we said next, it vests in 3 lots, 1, 2, 3 lots. And the first 3-year segment from 19 to 21 is what it vests. And it is dependent on same 3 things. What is your share gain? What's your EBIT margin gain? What's your cash? So we are aligning everything the shareholders want to what our turnaround strategy is, to what our people are going to get rewarded by. This is how we are stringing this together.
I have 2 more questions, one on Tata Motors Finance and on the other one on Onco. We haven't spoken much on Tata Motors Finance, and for many years.
Thank you for asking.
It's been one of the companies. Every second year, you will take a charge for provisions or NPAs, and then it will have a loss making. Last year, it has a 24% growth in asset AUM. To consistently perform, what are you doing for Tata Motors Finance?
I think first in all this is culture. Yeah. And
there is a synergy issue as well, because what I hear from the market is that many of the Tata Motors, many of the Tata Motors Finance don't finance Tata Motor vehicles only.
Okay, I think there's a lot of myths on Tata Motors Finance. So that's the reason I said no, guys. Let's put it right in front and center on this. I have no intention of overplaying or underplaying anything. Yeah, Tata Motors Finance has had a fantastic story this year. Yeah. But they've been on this journey for the last 3 years. Yeah. And the
last 4 years, 2 years, they had made losses.
Yeah, I'm with you. Look at how their GNPAs are moved. That for me is the health of the business and how they're selling. If you move from a 26% GNPA, which is absolutely unacceptable, to now a 4% GNPA, and in 1 year they moved from about 13% to 4%, means something is happening which is very different. And their brief to them is simple: boss, your job is to lubricate the sale and not push the sale. Very, very clear brief which I have given them. And as far as this 4% number is concerned, net NPS 3%, it will go down even further. And their profitability about 290 odd crores is happening after 2 years. Yeah. The previous year done that. But this one is absolutely with a GNPA at this level. So which means we are selling to the right people, we are pricing risk correctly, we are using the right level of source of funds to ensure that we are making a net margin which is sensible, which is the reason the ROA is at 17%. I would call it is not path breaking, but I'm happy with that profitability at this point in time. They need to grow their AUM, they need to increase their market share. Now they've got 3 companies in there. There's a holding company in the top, there is a financing arm of Tata Motors vehicles, and there is a used vehicles corporate lending business. Yes. each of them has their very clear role that we have laid out, and each of them has to deliver against that brief. The vehicle financing is the one that is so closely integrated with the Tata Motors ecosystem, and the reason why you are able to see their share gain, which is quite substantial this year, is because the teams now work together. Therefore, that is an area where for me, we have just started the journey. The technological opportunities that is there in Tata Motors Finance is phenomenal, because we are still some distance behind in terms of the market leaders as to how much of technology you can infuse into it. What kind of cycle times we can deliver? How fast can we clear a loan going forward? What's the kind of risk analytics that we can put onto it? Each of them we have moved a lot, but if I look at the fintech world, that is their benchmark to them. They have nothing to do with Tata Motors in their benchmark. Their benchmark is what are the world leader in fintech, and how can you ensure that you are able to benchmark?
What is the kind of capital that Tata Motors Finance will
Typically, this year we put about 300 crores into Tata Motors Finance, and I think on a yearly basis their requirements is about 400-450 crores is what I would expect. I should mentally be prepared for.
Okay.
But what we have said is it's a strategic asset, but that doesn't mean we have to hold 100% of it. And we will maintain control.
So you're willing to go public with that company?
We have said that. No, we won't go public with that. We'll have to see what way it is. Right now I'm saying that 100% is what we are currently holding. We are very clear it is going to be, we will control that company, because it's absolutely integral to Tata Motors ecosystem.
Yeah.
And at the same time, we don't have to be the only player in that company. And who are the right partners, what are the right way to do it? I think those are journeys that we will take later. We have said right now, continue in your journey. It's just, you are my fifth cylinder. That fifth cylinder needs to fire completely. There's no reason we are at this level.
So there would be some monetization of Tata Motors
at some point in time.
That brings me to the last question on non-core assets and monetization. You shifted to assets to held for sale, Tata Technologies. That's and right. Tata Hitachi, assets of nearly 2,700 crores. But what would be the intrinsic market value for that? What kind of assets there? How big is the asset base for them?
See, I think both are very strategic assets built with a lot of passion, love, and a lot of care. So we are absolutely clear that it has to go to a person who can actually build it even further, and we let it fly. Tata Technologies is very core to Tata Motors and JLR. Yeah, because they are very much an integral part of our designing and the way we build cars. And they have some enormous capabilities in electric, for instance. The work that they've done with NIO is outstanding. And therefore, we would want to go to a player who can actually really build it and take it to the next level and add value back to us through their operations. But that doesn't mean we have to control that entire business. So we said we are more than happy to give 100% of it out, because it's a very, very core vendor for us. That's the way we would like to look at it. As far as Hitachi is concerned, the construction business has been doing exceedingly well in the country after infrastructure has kicked in. Look at the tipper truck sales. Very obvious. And this year they've had a dream run in terms of performance, and therefore I think they are at the start of the journey of how much they can actually deliver. So we have said that business requires capital. That business is the right time to actually say that this is not our focus area going forward, because we would want to be in this side of the business. And we've already stepped down to about 40% of the company is what we currently have. So we said there's no point sticking on at this point in time. It would rather be better that Hitachi takes it and runs with it completely. And because they need faster decision making, they will need capital to come in free at a notice, and so that business can blossom out and prosper. So that's how we are having conversations with Hitachi on. And value-wise, I think we should be fair in terms of how we value it for both parties. The buyer and the seller both have to have a sensible number which they can. Yeah, this makes sense, and we go with that.
Now there are so many subsidiaries within Tata Motors which have huge asset bases, low cash flows and low profit to the group. Will you be looking at all those subsidiaries? Because
every one of them is being reviewed. That's the reason I've said in my slide, wherever you're taking a decision, you put it out there. Everything else is on strategic review at this point in time, barring Tata Motors Finance and JLR.
Balaji, thank you very much for joining us today on BloombergQuint.
My pleasure.
Thank you.
Thank you.
Thank you.
Thank you.